I'm gonna start. All right. Sick. This dog just knew it was now is the right time to start to bark. He's hyped too. All right, guys. So as you guys saw, today's session is called Decoding Exponential Growth. Right? Decoding exponential growth. And what I'm gonna do is I want this to really click for everybody. So really stick with me. And some of the things I'm gonna say, they're gonna come together a little bit later on. So they might not make sense in the moment, but they'll make sense a little bit later on in the training. But to give you guys perspective, compound interest, quantum leaps, you guys have heard of these things, right? Let me know in the chat, drop a 7 in the chat if you've heard that before. Compound interest, eighth wonder of the world. You know, some things, you wait, so long for them to happen, and they happen in an instant. I remember I heard that one time. It's like, sometimes we wait 10 years for one moment, and then in a moment, 10 years happen. And so that's what I want to talk about today. And I got some interesting perspective, just reading some videos, things like that. And I want to give you guys some perspective on longevity in markets, investing, and in yourself. And the first thing I want to just give you guys a fact. Okay, here's one fact. I'm sure y'all have heard of Warren Buffett before, right? Warren Buffett, the richest investor of all time. Now, Warren Buffett is worth a bit over $110 billion. All right, cool. That's a good fact. But here's the crazier fact. 107 of those 110 billion came after he turned 65 years old. So after he turned 65, he went from 3 billion to 110 billion. Not bad. Doing okay, right? Now, with that being said, what? Imagine you're 65, 3 billion, obviously you're doing great. And then everything that happens after, you get another 107 billion in your net worth. So that's what I want to talk about today is how does that happen? Because our minds aren't even able to kind of handle, like, you guys are speechless. I'm here and you're like, wait, what? Making over 98% of your net worth after you're 65. It's pretty absurd. And so in order for that to make sense, I'm going to tell you guys a little bit about the ice ages. Now you're probably thinking, what are you talking about, bro? Ice ages. Why do I need to know about ice ages when it comes to money? How do these connect? And it'll make sense here in a second. But if you guys didn't know, we've experienced at least 5 ice ages on Earth, right? And by we, I mean the planet, obviously not us. But for most of human existence, we didn't understand why, right? We didn't know what was going on. And there's a whole bunch of different theories on why ice ages happen and things like that. And a lot of them made sense for maybe one ice age, but no one could really narrow down why does this keep happening? And it was hundreds and hundreds of years and no one could really figure out what was going on. And eventually the Serbian scientist in the early 1900s, he kind of, he figured it out almost. But basically he realized, because he would study the Earth's position relative to other planets and the sun and the moon. And what he realized was the gravitational pull of the sun and the moon just gently affected the Earth's motion and the tilt towards the sun. So it moved a little different and it was angled a little different towards the sun. And so during parts of this cycle, when this would happen, which sometimes happens for 10,000s of years, each of Earth's hemispheres get a little bit more or a little bit less solar radiation than they're used to. So every once in a while, we get a little bit more or less radiation. So what does this have to do with money? So basically, this Serbian scientist, his name is Milutin Milankovic. Now, he was saying, all right, so when this happens, then this causes insane winters, super cold times. And he was wrong. He was close, but he was wrong. It wasn't until a Russian meteorologist figured it out. And here's where it'll start to come together a little bit. It wasn't that the winters were, like Chicago in where it's, 30 degrees below zero. It wasn't that it just became, just some blizzard. It was that the summers were just cool enough for this to start to happen little by little over hundreds of years. So when the summer didn't get warm enough to melt the previous winter's snow, the leftover ice base made it easier for snow to accumulate. Which, when the snow starts to accumulate like that, it attracts even more. And perpetual snow, it reflects off the sun rays. A lot of science stuff happens, and basically more snowfall happens. And within a few hundred years of this happening over and over again, you get a continental ice sheet and you have an ice age. And the same thing happens in reverse. That little bit of a tilt, just that small tilt, and one where it gets just a little bit more radiation and a little bit less solar radiation, that creates hundreds of years, thousands of years of ice ages. And that's what I'm here to talk about with compound interest. So the amazing thing here is how something so big, imagine the whole planet covered in ice, right? Started to grow from a really small changes in conditions, right? Really small changes in conditions. So it starts with the smallest, thinnest layer of snow left over from one cool summer. No one would even think about that. And then from there, it turns into an ice age. So what's the takeaway, guys? From ice ages, you don't need tremendous force to create tremendous results. If something compounds, even if it's the smallest bit, if it serves as fuel for future growth, all you need is a small starting base that leads to extraordinary growth. And it defies logic. Like, you wouldn't think about it. I mean, how many people here have ever seen like a compound interest table and if I invest $50 every week, doing whatever percent every month or every year, it just turns into some ridiculous number that you can't even embody it. You're just like, what? And let me ask you guys a question. And I need y'all, only thing I need is your reciprocation. I need y'all to just give me a little energy back. But how many people here have seen the compound interest table? How many people here have seen if you start investing at 20 instead of 30, this is how much more you'd make by the time you're 65. All right. So drop some ones in the chat if you've seen that before and you're like, oh my God, I would make $10 million more if I just start today. And it's like, you either make $1 million or like 15. It's just like an absurd amount. So a whole bunch of people here, we know that this is true. So why is it that maybe 5% of us have actually started doing anything? Like, we know the numbers, like we see the numbers and you're like, this is crazy. Oh my God. And you get hyped in the moment. But why is it that most of us, and I know we got some guilty people here, right? Myself included. I saw these numbers back when I was like 20 years old, and it took me a bit of time to actually go and do it, start putting money into even not even high risk investments, but just something to work a little bit. Like, why is it that we're not doing it? If we know, even if you just put it in the S&P or a NASDAQ, or Dow Jones, and you just let it ride. And it's not actually so much the fear. It's that we just can't quantify. Like, it's just so illogical that we can't process it. And I'll go into this in a little bit here, but I want to give you guys some perspective. Because we always talk about Warren Buffett and how, wealthy and he's the GOAT of investing, etc. But the reality is this: he's actually not the best investor of all time. He is the richest, but he's not the best. And I'll tell you guys more about who is the best in a little bit. But There's been thousands of books written about Warren Buffett and how he made his money. But what a very, 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 very small amount of books talk about is one fact. And it's the simplest fact. But his fortune didn't really come just because he was a great investor, but it's because he's been literally investing since he's 10 years old. Yeah. Warren Buffett has been investing since he was 10 years old. As of right now, right, his net worth is over $110 billion. But check this out. Here's a crazier stat. Out of the $110 billion that he's worth right now, 109.7 he made after he turned 50 years old. So I'll give you perspective. 50 years old, worth roughly $300 million. Today, worth well over 110 billion. What? What? Y'all hear that? Like 300. Maybe I just need to write some of these numbers down. I think sometimes y'all just need to see the numbers just so you kind of get it. I'm saying he went from 300 million. Cool. Right? 50 years old. 50 years old. To however old he is now. I don't know how old he is now. I think maybe like 89 or 90 or something. Present day. Right? We're talking 110. Not million. We got to throw another comma in there. 110 billion. Guys, we got 3 extra digits. 3 extra digits. This is not 10 times more. This is not 100 times more. This is almost 400 times more. Turns 50, obviously already very wealthy. So how does 99.9% of his income or his net worth come now? What? He's a great investor. Don't get me wrong. And here's the thing. He went from 300 million to about 3 billion from 50 to 65. So he basically 10x his income from 50 to 65. But then from 65 till today, he threw another 107 billion at that. So, okay, let's get to the point. So the key point here, the key to the success is that he's been a phenomenal investor for over 75 years, right? For over 3/4 of a century, he's been investing. So had he started investing in his 30s and retired in his 60s, no one would know or even care. So I'll give you guys perspective, right? So Warren Buffett, here's what happened, right? He started investing when he was around 10. And by the time he was 30 years old, he had a net worth of $1 million. So by the time he was 30, net worth of $1 million. Now, if we adjust that for inflation, it's a little bit over $9 million. Okay, by 30. Doing all right. But what if he just chilled during his teens and his 20s, and by the time he was 30, let's just say he had 25K instead, right? And he did great investing from 30 years old to 60. So 30-year span of investing, made 22% a year. That 25K would look like right around 12 million. So 12 million, 25K to 12 million. Now that's a great life, great net worth. That's, you're putting your family in great position, couple generations maybe. But that's 12 million, not 110 billion. How do we go from 12 million to 110 billion? And it's because of the time. It's the amount of time. So basically, Warren Buffett's success really came down to the longevity. And this is what I want you guys to write down. The skill is investing. but the secret is time. The skill is investing, but the secret is time. And that's how compounding works. Now, remember, I told you guys about someone being a better investor. Warren Buffett's a GOAT. He's the wealthiest and the richest to date, but he's not the best. So let me tell you about someone who is the best, right? His name is Jim Simons. Now, Jim Simons, he's the head of a hedge fund, and he's compounded, right? He's done on average 66% a year since 1988. So for the last 35 years, my guy Jimbo Simons has been doing 66% on average. That's 3 times better than Warren Buffett. And no one even really comes close. Not at this scale. But here's the thing, right? Simon's net worth is almost 30 billion. So how is Simon's net worth a quarter, a fraction? How is he 75% less wealthy than Warren Buffett? And it's because Jim Simons didn't really figure out investing at this level until he was 50. So it wasn't until he was 50 where he started to figure it out. That's the difference. It's that Warren Buffett started investing basically 40 years before that. So at 50 years old, I mean, he still started going crazy. Let's not get that mistaken. But I want you guys to understand, and I want to give you a perspective of compound interest and the power of time. So let's say, what if we gave Jim Simons the same opportunity as Warren Buffett? And let's say, we're going to give him 70 years. So instead of Jim Simons, investing for the last 35 years or so, we're going to give him over 70 years. We'll double how long he had been investing. Let's say him and Warren started at the exact same time. Okay, let's say that's the case. I want you guys to understand, like this. I want you guys for this to click for you. I'm gonna pull out the whiteboard again. All right, pull this out here. All right, and we're gonna compare. We got our boy Warren Buffett, WB, cool net worth of 110 billion. Good life. And we got Jim Simons. Now, let's say we gave Jim Simons the same opportunity. 70 years of investing, starting at the same time. Now, Jim Simons is doing average 66% a year. So I want you guys to see, this is what it looks like. All right, hold on. I want to make sure this makes sense for y'all. I really, really want you guys to understand the power of what I'm about to show you. This is what he did. He did 63 quintillion. This is what it would look like. 900 quadrillion. I know it sounds insane. 781 trillion. 780 billion. 748 million. I know. 160,000. What? What does that even mean? What does this even? What? I'll write it down for you, because this will be a little easier, right? 63 quintillion, 900 quadrillion, 781 trillion, 780 billion, 748 million, 160,000. So if our boy Jim Simons would have had the same time, he'd have an extra 15 digits here, or my bad, an extra 11 digits here This number doesn't even make sense. This is just absolutely ridiculous, right? No one has even cracked a trillion, not one person at least, let alone, quadrillions and quintillions and all. Like, some of you had never even heard of these words before in your life. But that's the power of time. That's the power of time. Now, obviously, these are ridiculous, impractical numbers. Yeah, it looks like a crazy code. It looks like some, GTA code or something. But the point of this is what seems like small changes in growth. These can lead to ridiculous numbers. And this is why Warren Buffett got so wealthy. And so here's why, right? Like, everyone that's seen, like, you just saw that and everyone was like, what? Like, it was just surprising, but it's real. The numbers don't lie. But why is it that it just didn't seem right? And it's because, guys, we're programmed to think linearly. Linear thinking is much more intuitive than exponential thinking. We know linear thinking. Let me, like, for example, if I ask you guys right now to add 9 plus 9 plus 9 plus 9 plus 9 plus 9, some of you could figure it out. Okay, hold on. 9, 9, 9, 9. Oh, okay, cool. 54. Great. But if I ask you, okay, 9 times 9 times 9 times 9 times 9 times 9 times 9, you're not gonna give me a number. Not from your head, right? So exponential growth, it's hard for us to just wrap our heads around. Compounding like that, it's complicated for us to understand because it's not something that we're used to. It's not something that we're familiar with every day. And it's not just, most people, everyone has such a 99.9% of people have such a hard time understanding this idea. I'll give you guys another example of how we constantly underestimate compounding. So IBM, the technology company, they made, you guys, the hard drives that you guys have now. Let me know in the chat, like, how much storage your hard drive has in your computer. A lot of you have 250, 500 gigabytes, a terabyte, whatever. Some of you don't even know. But back in the 50s, a hard drive was 3.5 megabytes. So, like, the size of a picture, basically, was what it was in the 50s. Then in the 60s, they started getting some progress. We had a few dozen megabytes. All right, we're making some jumps. In the 70s, IBM's hard drive hit about 70 megabytes. All right, so we're growing. And then by the early 90s, these hard drives were from 200 to 500 megabytes. All right, so like one short video. Early 1990s, we're talking 200 to 500 megabytes. And then all of a sudden, in 1999, Apple drops the iMac, and it's 6 gigabytes. So boom, 10x. A couple of years later, 4 years later, 120 gigs on a computer. Another 20x. 3 years later, 250 gigs on a computer. 2011, the first 4 terabyte hard drive. 2017, 60. 2019, 100 terabytes. So I want to give you guys a perspective. For 40 years, from 1950 to 1990, we gained 296 megabytes, right? 296, 3 digits. But then from 1990 to today, we gained 100 million megabytes. 100 million megabytes. 40 years, only 296. And then late 1990s hit. In the last less than 30 years, we gained 100 million megabytes. Again, compound growth. Compound growth. So nobody would have guessed, yeah, you know what? In 60 years, I think we're going to see this technology grow by 30 million times larger. Nobody would have said that. Nobody did say that. So the counterintuitive nature of compounding leads even the smartest people in the world. Everyone underestimates this. Check us out. Bill Gates, as terrible of a human being as he is, he's pretty good with money, right? He's made a lot of money. But in 2004, right, Bill Gates criticized Gmail for their storage. And he said, why would anyone ever need 1 gigabyte of storage? In 2004, this is what he said. Why would anyone need 1 gigabyte of storage? Meanwhile, most phones, whatever you have in your pocket, has probably at least 64, 100, 250, some of you even more. So even Bill Gates, one of the wealthiest people on the planet, underestimated compound growth. So the danger here with compounding, the reason we underestimate it, the reason we don't take action that we could be taking, is because it's just not intuitive. It's not linear. So we really don't consider the actual potential of compounding. So look, there's so many books on economic cycles and trading strategies, and you have a million different things on what's going on in the world and how to make money. But the most powerful and important book should really be called Invest, Shut Up, and Wait. That's it. That's literally it. Just wait for a super long time. And so look, the takeaway of this is that the counterintuitiveness of compounding, it might be responsible for the majority of disappointing trades, bad strategies, and successful investing. So what I want you guys to really take from this is, look, yes, you want an edge as a trader, as an investor. Yes, you want to time the market properly. All those things are really important, but because it just makes sense. But good investing isn't necessarily about earning the highest returns, because the highest returns sometimes are just one-hit wonders and you don't even know how to do it again. But it's about earning good returns that you can stick with over a super long period of time, because that's when the compounding goes crazy. And here's the thing, the opposite of this, which is earning huge returns that you can't sustain, this leads to some pretty devastating stories. And that's what I want to talk to you guys about, because investing is a double-sided coin. You have the beauty of compound interest, and then you have the tragedy of greed. So I want to tell you guys this couple stories, because I think stories is what, at least in my understanding, and for me, I think stories are what connect. It's what makes emotional impact. It's what drives us to making good decisions in the future. So good investing isn't necessarily about making all the great decisions. Sometimes it's just not making mistakes. It's just not colossally messing up. So there's a lot of ways to make money, guys. There's a lot of books, there's videos, courses, academies. But there's a lot of ways to get wealthy. But there's only one way to stay wealthy. And it's a combination of being frugal and being preventative. And this is what we don't talk about enough. So I'm going to tell you guys a story of two investors. And they crossed paths in a really unique way. And this happened almost 100 years ago, but it's as relatable as possible today. So one of the greatest traders ever, like in terms of returns, his name is, or was, Jesse Livermore. Some of you maybe have heard of Jesse Livermore. Now, he was born in 1877. And he became a professional trader before most people even knew what trading was. Right? Again, super young. By the time he was 30 years old, his net worth adjusted by inflation was $100 million. Imagine that, 30 years old, 100 million net worth. You're a trader. Yeah. So by 1929, which it was the year of the Great Depression, by 1929, Jesse Livermore was already one of the most well-known investors in the world. And in 1929, the stock market crashed. And that's what, it's called the Great Depression. And this is where it cemented his legacy in history. So during this week, a week in October 1929, guys, this week is so iconic that it's literally like 3 of the days are named Black Monday, Black Tuesday, and Black Thursday, because the market literally died. The stock market, not crypto, the stock market died over 30%. Over a third of the market crashed in a couple days. All right. So in October, late October 1929, over a third of the market crashes. Yeah. And Livermore's family, they're fearing the worst. All right, it's October 29th. Jesse Livermore gets home. And, they're crying. Family's crying. There's people all over the news that committed suicide because of just the tragic losses. People were over leveraged. So much wealth and money was just obliterated over the week. And so his family's crying when he gets home. And he's standing there confused, according to the biography, standing there confused, like, what's going on? And then he broke the news to the family, right? In a moment of genius and luck, he shorted the market. Jesse Livermore caught the greatest drop. And overnight, made $3 billion. $3 billion trade. So let y'all sit on that for a second. So his wife's like, oh my God, so we're not ruined, right? We're not broke. Oh my God. He's like, no, I just have the best trading day all the time. We're rich. We can do whatever we want. And so, cool. One day, Jesse Livermore makes $3 billion. So during one of the worst months in the history of the stock market, Jesse Livermore became one of the richest people on the planet. Now, cool. Celebrate. Happy day for them. Sad day for most people. And now the same week, there's someone named Abraham Germansky, multi-millionaire real estate developer who was just killing it in the 20s. And economy is booming. So what did he do? Just like every other successful New Yorker during the 1920s, he bet heavy on the stock market. Heavy. October 26, 1929, the New York Times publishes an article in 2 paragraphs presenting a tragic ending. And in these articles, basically, there's an article that says Abraham Germansky of Mount Vernon, missing since Thursday morning. 50 years old, real estate operator, has been missing for days, heavily invested in stocks. And someone had seen him. A friend saw him late Thursday on Wall Street near the stock exchange, and he was just tearing up strips of ticker tape into bits and scattering it on the sidewalk as he walked towards Broadway. And as far as we know, that was the end of Abraham Germansky. Never found him. So why am I telling you this? During October 1929, Jesse Livermore became one of the richest men in the world. He literally went down in history. We're literally talking about him right now. That same day, it ruined Abraham Jermansky's life. But fast forward 4 years, these stories crash, they cross paths again. And in 1929, right, Livermore crushed it, one of the richest people in the world, became very confident. And he started making bigger and bigger bets. And he ended up going over his head, increasing amounts of debt, and he eventually lost everything to the stock market. Imagine having a $3 billion trade and you go and 4 years later lose all of it. All of it. So in 1933, he disappeared for 2 days, right? There's an article in the New York Times, Jesse L. Livermore, stock market operator, missing, hasn't been seen since 3 p.m. A few days ago. He returned, but at that point, he knew. And eventually, Jesse Livermore took his own life. Now, the timing was different, right? Jermansky came up in the 20s, stock market bodied him. Jesse Livermore made it one of the greatest trades ever in history. 4 years later, greed got to him. So these were both people that were very good at getting wealthy, but equally as bad at staying wealthy. And this is what most people don't talk about, is staying wealthy. Not getting wealthy, but staying wealthy. And this is what I wanted. This is the whole point of this. It doesn't matter how much you make, it's what do you keep. And even if wealthy, maybe that's something, maybe you don't consider yourself wealthy, and that's okay. But at all income levels, like this makes sense. Getting money is one thing and keeping it is another. So what is money, right? To summarize money in a word, it would be survival. Survival. Guys, look, 40% of companies that become publicly traded eventually just don't exist. Think about that. The Forbes 400 list of richest Americans, on average, roughly 20% turnover per decade. 20% drop from that list. So remember, getting money and keeping money, two different skill sets. Getting money requires risks, optimism, taking leaps of faith, skills. But keeping money is almost the opposite. It requires humility, fear, but used properly. It requires frugality and acceptance that, hey, look, some of this might have been slightly luck, timing, but past successes don't lead to future successes. And so some of the people that have really held and kept their income, their wealth for the longest, these are people that don't become complacent, right? They don't assume yesterday's fortune means tomorrow's. So it really comes down to survival, right? The ability to stick around for a long time without wiping out or being forced to give up, that's what makes the biggest difference. So there's two reasons, right, why a surviving mentality is so key with money. The first one, there's few amounts of risk reward that are worth putting everything on the line over. It's not worth it. Especially the older you get, the less worth it that would become. So compounding works if you give your asset years and years to grow. It's like a bamboo tree. Right? You don't really see anything the first couple months, but give it some years and all of a sudden it's just astronomical. But keeping extraordinary growth requires surviving all the unpredictable ups and downs that you might not have experience with. So we can spend years trying to figure out, how to find the best companies and the best cryptos and the best edge. But look, here's how you keep it, right? You don't get too carried away with debt. You don't panic and sell during recessions. You don't put your reputation on the line. You don't get attached to any strategy or social structures on what you should have, right? You don't hop on every trend that shows up, and you don't rely on other people's money completely. And what I mean by that is leverage. So survival, guys, survival is the name of the game. That's why Warren Buffett has been able not just to survive and literally stay alive, but physically and financially, is because he didn't get carried away with debt. He didn't panic and sell during the 14 recessions that he's lived through. Warren Buffett has seen 14 recessions, 15 if you include the one that's basically happening right now. So I'm going to give you guys one more story and we'll wrap this up. So most people know about Warren Buffett and Charlie Munger. People that are like super, nerds about investing in this stuff. You've heard of Warren Buffett, Charlie Munger. Those are like that's the dynamic duo. They run Berkshire Hathaway. But there was a third. It was a trio at one point, and his name is Rick Guerin. Rick Guerin. Now you probably haven't heard of Rick Guerin, and that's because a little over 40 years ago, he messed up. But there was a third member of the group: Warren, Charlie, and Rick. They made investments together, right? They ran up Berkshire Hathaway together. And then at some point, Rick kind of disappeared. And so here's what happened. Here's a quote from Warren Buffett. He said, Charlie and I knew that we would be incredibly wealthy, but we weren't in a hurry to get wealthy. We knew it was going to happen. Rick was just as smart as us, but he was in a hurry. So what happened was in the 70s, right, there was a little crash in the 70s, and Rick was over leveraged with margin loans. And so the stock market went down almost 70% in between 1973 and 1974. So we got margin called. And he sold his Berkshire stock to Warren Buffett. And Warren actually said, right, I bought Rick's Berkshire stock at under $40 a piece. Rick was forced to sell everything because he was over leveraged. So Charlie, Warren, and Rick were equally skilled at getting wealthy. But Warren and Charlie had one extra skill, and it was staying wealthy, which over time is the skill that matters the most. So having an edge and surviving, these are two different things, right? Having an edge and surviving are two different things. The first one requires the second one. You need to avoid ruin at all costs. As traders, this is where most people make mistakes. They're looking to make the gains, but they're not looking at the other side. How do I stay in the game? How do I make sure I don't hit certain drawdown levels? We're focused on the profits, but not the protection, the capital preservation. So applying survival mindset to the real world, there's a couple of things, right? One, more than wanting big returns, you want to be financially unbreakable. And if I'm unbreakable, I actually think I'll get the biggest returns. Because if you can stay in the game long enough, then eventually you'll get the right pitch that you can take the perfect swing at. So you can stick around long enough for that compounding to work. That's the difference. Because look, compounding doesn't really rely on the big returns. It's just good ones sustaining over uninterrupted over a super long time. That's why, like, if you use this perspective with Bitcoin, like yes, of course you can time it out, and you want to pay yourself at the right moments, but if you can just stay in the game long enough, it'll make the most sense. But it's way more time than you've ever thought about. Most people don't even have a year plan, let alone a 5-year plan, let alone a 10-year plan, let alone a 25 to 50, 75-year plan. So speaking of plans, 2, planning is important, but the most important part of every plan is to plan on the plan, not going according to the plan. right? The most important part of every plan is to plan on the plan, not going according to the plan. There's a saying that says, you plan, God laughs. So look, of course, we gotta have that plan, but you have to understand that you can project your income, your savings rate, which, by the way, your savings rate is way more important than even what you make. You can project, okay, how much of the market's going to be returning every 20 years or the next 20 years. But there's so much that happens that we just don't predict. So you have to predict that there will be unpredictable events. In the last 20 years, who would have seen 9/11, the housing boom and bust, right? 10 million Americans losing their jobs, financial crisis that 9 million Americans lost their jobs to, right? Record-breaking stock market rally that happened right after it crashed. Who would have predicted COVID? Well, I guess people did, but that's a different conversation for a different day. A plan is only as useful if it can survive reality. And a future filled with unknowns is everyone's reality. So a good plan doesn't pretend that there's not going to be unexpected events. You have to be ready for those things. So you want to create room for error. Room for error. This is called margin of safety. All right, margin of safety. And this is one of the most underappreciated things. One of the most underappreciated things in finance is margin of safety. Now, margin of safety is basically raising the odds of success at a given level of risk by increasing your chances of survival. It's magic. Is that the higher your margin of safety is, the smaller your edge needs to be to have a favorable outcome. So for example, let's say you're trading, and yes, you could risk 1%, 2%, and you could have some good gains. Okay. But what if you hit a losing streak and you go 10, 12% drawdown? Okay. But on the other side, what if your risk is a 0.25%, 0.25%? Then the chances of you not surviving are very, very low. And the chances of you making growth are pretty good. So the chances of you staying in the game are so much higher than they would if you had more risk, which, yeah, there might be more gains, but was it even worth it if you're not going to stay in the game? So the last part is, in terms of survival mentality, it's called a barbelled personality. You're optimistic about the future, but paranoid about what will prevent you from getting to the future. So optimism is usually, belief that things are going to go well. And this idea is called sensible optimism. It's a belief that the odds are in your favor, and over time, things will balance out into a good outcome. But there will be an in-between of, suffering. There will be things that don't go in your favor, but long-term it will. So that there's going to be, quote, misery. So you can be optimistic about the long-term growth, but you also understand that the road in between is filled with landmines. So these are the things that make such a massive difference. You have to understand, long-term, guys, it's lit. Here, I'm going to show you guys something here real quick. Check this out. This is this right here is a chart of the GDP per capita from 1850 till now. But in this process, 1.3 million Americans died while fighting 9 major wars. In this bullish process, roughly 99.9% of all companies that were created went out of business. In this bull run, in this whole, the last 170 years, 4 U.S. presidents were assassinated. 675,000 Americans died in a single year from a flu pandemic. 30 separate natural disasters killed at least 400 Americans, and 33 recessions that have lasted a cumulative 48 years. So in this big, very bullish process, there are unexpected moments of chaos. A lot. The stock market fell more than 10% from a recent high at least 100 times since then. There were 12 moments where the stock market lost a third of its value. But in the last 170 years, the standard of living has increased 20-fold. So you need short-term awareness to keep you alive long enough to exploit long-term growth. So don't learn the hard way. Don't learn the hard way. So guys, remember, getting wealthy is very different than staying wealthy. So let's focus a little bit more on staying wealthy.